let me bring in William and Gunel. They are the members that we will be talking about in their project that they have. There they are. This project, I'm excited to hear about it. I haven't heard anything about it since our master's bus tour, which it was on in, when was the expo last year? I think it was in January or February, earlier this year, I should say. And this was one of the properties that we talked about. I'll also tell you, as a mentor, I mentored multiple people on this project before it got to William and Gunel. And people were approaching this from different angles. And I forget which was which now, but I think it started out as it had to be a loan assumption per the seller. And that didn't work. And we analyzed it for a couple of different people that way. You guys actually figured out how to do it with a new loan and renegotiated the whole deal and got the seller to change it. Is that correct?
That's correct, yeah.
Okay, so I'm remembering it right. Okay, so with that intro done, you guys have a pretty interesting background. These are some folks that I guess found us in the U.S., but they've been worldwide and international coming to us. So I'll let you take over and pick up on your background.
Okay, good afternoon, guys. Thanks for having us here. Guys. So yeah, let's talk about our background. So my name is William. I'm a petroleum engineer by degree. I work in the oil industry for 20 years. I graduated in 1996 and didn't have any experience in real estate at all. I mean, I went and traveled the world. I probably spent 20 years traveling overseas, going to different countries. Originally from Colombia, South America, became a citizen of the US in 2018.
My name is Gunel. I'm originally from Azerbaijan. Not a lot of people know where that is. They can barely pronounce that. So it's east of Europe, right in the middle of Russia and Turkey. I have a lot of degrees. Not all of them are here. I have a journalist degree, interior design degree, and real estate degree. But those two that are here are actually very beneficial in the business that we're doing right now. And I became U.S. resident in 2020.
Just this year, so. So like we said, we live overseas for 20 years. We relocated back to Houston in 2014. I live in different countries for a while: Argentina, Scotland, Angola. I lived in Azerbaijan, where I met Gunel, and our last stomping ground was Trinidad and Tobago. So I tell people that was the closest I could get to the beach without getting paid. So.
I was actually meeting with a banker today that's from Trinidad and Tobago, and he was telling me it's the place to go.
Tobago is. I don't know about Trinidad. Yeah.
We both are IROP certified. I received my CAMP certification a month ago. William needs to do his. We joined Lifestyle in 2015, and just 3 months after we moved in to Houston. So we jumped into doing real estate.
So we currently manage 3 communities. One is 108 units. The second community that we bought was 135 units, and 115 units, which is the one that we'll be talking tonight. We are lead investors, and kind of what I tell everybody is we went from 0 units, 0 experience in real estate, to 108 units on our first deal. So we didn't go slowly through it. We just went 2 feet in and never looked back after that.
We get a lot of questions. Have you done any passive deal? Have you done any single family? And our best stories now, we just went straight with 0 experience in real estate to 180 units.
Yeah, and we currently have our own management company, and we have 11 employees, and we're growing as we speak.
So let me just build on that. You know, there's a lot of avenues that you can go down in the multifamily group. We have some people that come in and they want to be IROs, what we call independent rental owners, and we size them up and decide how big of a property they can tackle based on the proceeds and the funds that they have to do it and their experience. Other people want to come in and be leads like these two have become. And we have many, many members that are just passive investors. So they may have their money in IRAs, the stock market, wherever they have it right now, and they're looking for an alternative investment, a better return, a more stable and positive trajectory for their investments than what they're experiencing currently. Those are the types of people that we link up with William and Gunel, and they invest alongside of them. William and Gunel put some money in the deal, the others put some money in the deal, but William and Gunel do all the heavy lifting and all the hard work, and they just return mailbox money, as we call it, back to the investors on these deals on usually a quarterly basis.
That's correct.
How did you join Lifestyle Limited? We have a friend, at that time he owned around 40 single family houses. Right now he probably owns around 100.
Yeah, a lot more now.
I think he buys one every week. And he mentioned us because when we moved from Trinidad, we were thinking about starting a real estate business, but we were not sure what exactly we want to do. We were watching HDTV, flipping houses sounded attractive, but we kind of didn't know exactly what is our niche. And he introduced us to Lifestyle Limited, and he said, hey, go to case study, watch the Dell, and you get a entertainment. You will at least enjoy the entertainment of watching Dell at that time.
Yeah, so we didn't, like we said before, we didn't have any experience. We kind of wanted to go into real estate, but we didn't really know how to do it. And when we started, our goal was to basically leave the current job that we wanted. So that was one of the reasons that we went and decided to be lead investors. Yeah. The property that we're going to talk about tonight is it's called Fall Creek Square. It's located in Humboldt, Texas, which is just a suburb outside of Houston. That's actually where we have our house. We also live in the same area. It's a funny story because the property is in the exit to the freeway when we get our subdivision. Yeah, we've seen it before, and we said, hey, one day we'll buy that property, but it just kind of fell into our hand after it dropped out of contract. So we actually got a call on December 25th on Christmas and say the property fell off contract. Are you still interested and can you make it work? So that was our Christmas present in 2018, I believe. So.
I love that story because I actually own one that is catty corner across the street from an apartment complex that I lived when I got out of college. And I would have liked to have bought the one that I lived in, but Curtis actually got to that one before I could.
Yeah, and my parents were here right before Christmas, so we actually went and had lunch in a restaurant next to it. I said, oh, we wanted to buy that property, but it just didn't work out.
Yeah, and we said, like, if it didn't work out, I hope somebody will buy it and change that ugly exterior color.
So this property is 115 units. It was built in 2003, so it's a newer build. It was purchased in 2019. The purchase price was 12.6 million. That's 190K a door. The cash out of pocket that we kind of got with investors to buy the deal was $4.8 million. We had an initial financing of 9.48 million with an interest rate of 4.53, which it sounded really good at that time. And I look at the interest rates right now, and I'm not sure about it, but that's what we got it when we bought in the beginning of 2019. We put a 12-year loan in this property. It has a 30-year amortization, and we actually have a 6-year interest only on the loan. And like you said earlier, Scott, we went on an all cash offer, so we didn't assume the loan. Initially, the property was offered under an assumption, and we worked out our numbers and looked at it and said we can make it work with buying it all cash. So we had a rehab budget of around $1.1 million, and 750,000 of that was in the loan. And there's a picture of kind of how the property looks right now, the pool area.
So that's almost 10,000 a door, 9,000 a door, something like that you had in your rehab budget?
Yes.
Okay, so that's quite a rehab budget.
Yeah, and this rehab is a little bit different. We'll talk a little bit about it, but it was more around changing the exterior and changing how the property looked. I think in our budget, we had around 50 units to renovate. It wasn't that the property was in bad condition. It was just kind of for our goal was it didn't look the part of a better asset.
So the main goal of that property is that property located in an area where we have a lot of A-class type of properties, a lot of new construction. And the goal when we bought that property was to offer same type of look, same type of product, but a little bit less expensive when it comes to leases. So that was a kind of main idea. And that is the reason why we put a lot of money on the rehab to kind of compete with Class A, but we cannot really compete with Class A because they have all these fancy amenities that we cannot really offer, but offer affordable option at type of same look.
Did you have a question, David, or a comment?
Of course I do. Because all these people watching are going, I don't have $4.86 million to buy an apartment by myself. You didn't do this alone, did you guys?
No, we didn't. We have actually 62 partners in our deal, and we had any.
Two regular folks like Scott explained what a passive investor was, but people out there, they're thinking they need to come up 4.8 million. And my point is, for the new people watching for the first time, they just tune you guys out. So what was like your lowest investor? How much money did they put in? Like, what areas of the country are they from? Are they all from, Humboldt, Texas, or are they from all across America?
We have investors starting from $500,000 to 25,000.
So people as low as $25,000 could get in this deal.
Yes.
Now they probably own all the toilet seats, but they own part of it.
They get the same returns from that 25,000.
That's what I want people to understand. That's why I bring it up in a funny way. It doesn't matter if you put $500,000 in or 25 grand, a round number, 10% returns for this guy is a 10% for this guy. Okay, just so
we
you
have
understand.
investors all over the place. We have investors from Hawaii, from Houston, from all over the country. I think.
Right.
I haven't made a map of how it looks, but it's pretty diverse.
Yeah, that's my point, is because we have people from all across, we have a couple hundred people watching tonight, and they can be from all across America. So they could invest a deal like this regardless where they live, just so they understand that. Okay, that's all I'm chiming in about.
Excellent. Okay, next slide.
So just a little bit about the numbers. So the income for this property, we make around 127K per month. Our expenses are around 62K. Our monthly cash flow is plus or minus 22,000 a month. The current NOI that we have for our last T12, remember that we only owned this property for probably a year and a half, so we're still in early days of it. T12 is 722K. Our last T3 in the last 3 months, if you do an extrapolation of that, is a 780K. So we're well into kind of executing the plan that we have. Right now, our cash on cash returns that we're generating for investors is 5.4%, and our projections is to keep growing that to 8 or 9%. We are done with a lot of the renovation of the outside, but we haven't completed the whole kind of interior renovation. We're probably halfway done with that. And our original plan was 50 units. We're probably have how many? 20 left? 30 left?
20 left, 30 done.
Yeah. So we have distributed since acquisition a total of $195,000 to investors, and just kind of a current valuation on a 5 cap. 5 cap, you need to remember this is a newer asset, so we can use a 5 cap in this asset. If you use the T12, we are valuing the property somewhere around 14.5 million. And if we use our T3, which is what we want to keep hidden and growing, our valuation right now is around 15.5 million. So that means a capture around 2 to 3 million in less than 1.5 years of acquisition. We plan to supplement this loan in year 3 and 4, and we want to be able to pull at least 40 to 60% of the original investment. If we keep hitting our goals and we keep renovating the units and increasing the income and increasing the rent, I think we'll be on our way to get there.
Not including the cash flow.
Yeah.
Okay, so let me do a little bit, because those of us that have been around so long, we throw out slang and forget that there are some people that don't know some of this. So for those of you that are new to this, T12 means the trailing 12-month financials. NOI is net operating income. So if you look at the last 12 months that they have owned this thing has thrown off $722,000 worth of net operating income. However, they are still making improvements. We're still early in the game. And their T3, their trailing 3 months, are actually pointing towards $780,000. So almost $60,000 more currently versus what they did over the last 12 months. Now, out of the box, not huge, but they are distributing cash on cash returns to their investors of 5.4%. If you're in the stock market right now, how many of the stocks that you own are throwing off distribution rates of 5.4%? It's not that many of them in the world of the S&P 500 that are throwing off that kind of cash flow. And they are angling towards, with their improving net operating income, towards 8 and 9% in years 2 and 3. Okay. Now, where else was I going? Oh, their captured equity, $2 and $3 million. Remember, what was our total investment in this? 4.8 million?
Correct.
So they are angling towards a supplemental loan. What we can do on this type of loan that they have is take an additional loan for the increase in value that we have added to the property. In this case, they're looking to return somewhere between 40 and 60% of an investor's original investment in a one-time cash outlay thanks to the supplemental loan. And then those cash on cash returns that they're sending out every 3 months will continue on from there as well. So we have multiple ways that we're getting money out of this deal.
And for new folks, you know, a lot of this sounds like gobbledygook. I'm going to break this down to a third grade level this weekend, just so you understand. I know it sounds like a lot, but really look at it this way. If you're getting 40 to 60% of your money back, and Scott, how much tax are they going to pay when they get that money back? Zero, which is peeing your pants exciting. So that's what's all. And the same thing with that 5% return. No taxes, defer. That's what, and I'll teach you why this weekend, you know, just guys, people can follow along.
So just so you know, I'll throw in a little of my own texture here. My wife and I completed our personal tax return, you know, right before the due date a couple of months ago. And when she went to sign it, she was stunned by how much she thought I made last year. I had to point out there was a negative sign in front of it because of all of the losses that keep us from paying taxes on these things that we do.
Yeah, that's another thing with this property. We do what is called cost segregation, which is basically an acceleration of the depreciation. And on top of that, cash flow, I mean, for people that were able to use it, we got a pretty hefty kind of tax deduction on the first year of acquisition, which is not even factoring in the numbers that we're looking at.
So this is my favorite part, the rehab. I'm gonna talk before and after.
I'll be very quiet now.
So office at the beginning, it's a really spacious office, has a lot of light. The issue with the office before is that it had all these sapphire yellowish colors that kind of pertain into 1990s. And after shopping all these A-classes properties around us, we realized that we do need to have Class A office in order to push the product and all the rehabs and all the rehab monies that we are spending on this apartment. So the main thing that we did is that we added the storefront windows, and when somebody walks in, they actually see another amenity, not just an office, but amenity as a pool. That was one of the biggest differences. We also added amenities that office didn't have before, which was a business center and a nice coffee area bar. And this is another kind of picture of the before and after that you can see. So we put around $80,000 for this office, but when somebody walks in and they see this, it talks a lot. A lot of people say, oh, wow, and they just in different mode. We try to give them some coffee, some snacks. They sit down, they relax, they look at the view. And that's kind of one of the first things of indications that a person is going to lease. So I think the office played a big part on that.
One of the things we talk about is shock and awe, and this is definitely when you walk in, this is a jaw-dropping shock and awe. You can't tell in this picture, but through the back windows, the pool is right there, and then you walk past that on the tour to get to the unit that you're going to show. They've probably already made their decision before they ever see the unit they're going to live in this environment. It's spectacular.
When it comes to exterior paint, the property had we call it pure green color.
That's how it looked before there.
You would drive by and you would pass the property because it was a mist between those greenish colors and the big trees in front. So we trimmed a lot of trees. We changed the exterior color. When it comes to the pool, we resurfaced the cool deck, added new furniture. Another big difference that actually you can see the difference is that we washed roofs. As silly as it sounds, washing roofs did a big difference. You don't need to replace the roofs for them to actually look brand new. We only spent $3,500 a building, total of $15,000 to wash these roofs, and it helps to preserve roofs, removes algae, and kind of roofs actually looks much healthier than it was before. This is
I just one of my properties. It's amazing. And this picture, yeah, this shows it looks like a different roof.
Right.
Yeah, it looks like it's a brand new roof, and people ask us about that sometimes. It's like you put a new roof and you go, not really, we just wash it and clean it up and it looks like brand new. So
this is office entry. It had those colors that we changed. We also added the cedar type of finish, so you can stress where office is, and added those cool jars with artificial plants, and we redid the landscape, and we spent around 40,000 on landscaping, but that definitely paid off. Talking about the exterior and landscaping, not only we added landscaping, we also added drainage. I don't know if you can see those boxes here. Property before, you wouldn't like to go there during the rainy days without rainy boots. Everything was flooded. So we spent around $20,000 on adding drainage, and that improved the landscaping, because if you would put fancy flowers and you still get flooded every time it rains, none of those is going to survive. Also, we removed this nice dishes. That's a pet fee of William. William was walking with his big scissors first day with maintenance guy, and we're trying to trace where those dishes are coming from. So we got rid of all of that. And again, exterior color just made a big difference. I mean, property looks like it's just brand new.
we also replaced 100% of the ACs when took over. So
yeah, and every time we lease a unit, we push that we replace those AC, and it will be energy savings for residents. This is units before and after. We still have those units before as our regular units. Well, for two type of packages. The package on the right side has granite backsplash, has a pull down faucet, new hardware, new lighting package, new flooring, that kind of stuff, and new color scheme. We paint doors different color. Cabinets, original cabinets were in pretty good shape. Need to remember that is this 2003 construction. So all we need to do is just resurface the current cabinets. We didn't have to replace the fronts or anything like that.
Did you have to add the granite, or was it already there?
No, we have to add the granite.
Okay.
Yeah, the cost of the granite is still $100 for kitchen only, and $125 for each bathroom.
Okay.
So this is a summary of our cash flow and cash projections. So year one, you have our income, total income for the year, $1.5 million. Operating expenses, we started with around 817. The net operating income, 743. That was at the end of year one after acquisition. Mortgage and capex payment, 507. And the net cash flow when we took over was around 5%. So year two, which is basically the year that we're on, the main thing is we're still increasing our income a little bit, but some of the things that we had is when we initially took over, we had a lot more people kind of helping us, and the previous ordinance also had a lot of payroll. So we've been slowly decreasing that payroll and getting it to operate more efficiently with one person in the office, one outside, and we supplement that with people that rotate in our portfolio. So we're actually able to affect the expenses. You can see that had an impact on the net operating income, and that's what we're projecting. That will be somewhere around 6%. We're gonna keep doing some of this kind of cost savings things in the property now that we're getting into a kind of more stable and we know how the property operates. The big thing that we have to keep growing is, like we mentioned before, we still have 20 units to actually renovate and bump the rents on those, and we'll keep growing our kind of current market rents as the market moves up, and our projections are to go on a cash flow around 7 to 8% as we do
those rented units that we have, we increase in $150 on top of the regular units. And we also, even during COVID-19, pushing renewals, we increasing $40 on renewals.
Yeah, so we're bringing.
Oh, I'm sorry. Go ahead.
So we're bringing our current units into market. So that's the other big thing that kind of contributes to our income. We had a lot of vintage units that they've been there for a year that we're just saying, you want to stay in here, look at the things that we've done with the property. this is the new price for your unit. I'm bringing it back to market without doing anything in the unit. Yeah. So
Okay, so let me point out a couple of things here. We attack bettering the properties in two ways. One is the upgrades that they talked about, the granite, the ability to increase a rent by $150 a month after they've done their upgrade package to it. But they've also done an equal amount of savings on expenses. You kind of brushed over replacing an AC unit, but once you put a new one in there, you don't really have to touch that thing again for a while. So the repair costs, adding Freon, the labor associated with doing all that, you can start to push that down. And you see here that you're taking it from $817,000 in operating expenses in year one to $780 in year three. That's as big as the increases in rent, and it's really doubling essentially the value creation that you've got inside of that. David will get more into that in the 2-day, and he'll really map out, as he said before, on a third grade level of how we do all this stuff. But it's great that you're hitting it from both sides. I can tell you that, you know, as bad as this pandemic has been, we have found creative ways and implemented technology to where I have these properties that I call in-betweeners, and this one almost falls into it at 115 units. I've got some that are closer to 130 units. I was having a hard time running them with one person, but two-person put my payroll over where it needed to be. We've been forced to implement some things, and now I'm finding out that I can run 130 units with only one person in the office by employing some technology that we've had to do just to market and communicate with people in these kind of weird times that we're going through. And in the end, we're driving down the expenses, and we're going to come out the other end much better. So that's
yeah,
great.
well, also, this loan has a green loan qualification, and on top of replacing units, we replace LED lighting in every unit. So every unit has LED light bulbs, and
Did
that
you do
saves.
water conservation too?
Yeah, we did that. We on water conservation, the only thing we had to do is to replace aerators in the bathroom and shower heads. We didn't have to replace toilets, because when they checked toilets, they were fine. There was enough GPR, I think that's how you call it.
yeah, and on the expenses, one of the biggest things that we can optimize right now is personnel. I mean, when we bought this deal and when we looked at it, they had a huge amount of personnel. They had like 2 full-time maintenance and 2 people in the office, and even that was kind of one of the reasons that we said we can actually buy this deal, pay a little bit more, because there is savings in both sides if we run it the way we normally run our properties. So if you take an employee out, I mean, you're saving $30,000 to $40,000 right away, and you can replace them by either technology or having a part-time person that will help in it. It's like we don't need 2 maintenance guys, because there's very little things to do on the property. And like you said, we replace all the ACs, all the units are getting an upgrade when they turn over. So the amount of work is very few work orders that come up.
Yeah. Fantastic. Maximizing efficiencies on all levels. That's perfect. All right, next slide.
This one talks about our net operating income and the property value projections. Just to remember, the total out of pocket in this investment was $4.8 million. So the purchase price, when we took it over, it had an NOI of 672, and that was the property value that we paid, 12.6. In year one, that was kind of at the end of the first year, we got our NOI to 743, and in year two, we are projecting right now 780, which makes the valuation of anywhere between $4 to $15 million. And that's an equity capture around $2 to $3 million. And this is in addition to the cash flow that we generated. And what we see right now is that we have returns in 2 years of around 40% to 60% just in the equity capture, not including the distribution of money that we're going to keep doing every quarter.
So that's fantastic. I mean, imagine getting, let's just call it 50%. We'll take the middle number here, but 50% returns in 2 years, 25% a year, plus the cash flow, increasing that by another 5 or 6%, 30% returns per year on any other investment that you have. You might get it 1 year on a good year in the stock market, but we're doing it consistently, and this is over a potentially 3-year period by the time you do the cash. So that's phenomenal.
And all the depreciation that we also distribute.
And our original projections when we started, we thought we could probably hit 30% after 2-3 years. So we're already above that, and our plan is to keep it. So.
And it's tax-free. Perfect. All right, next slide. All right,
So
so
how
let's
do
talk about
we
how you
do
got there.
this? I always like to have lions in my slides, so there is one. So I think you kind of have to focus on what you want and kind of focus on your objective. One of the biggest thing is take action. I mean, we joined Lifestyles in 2015, and after kind of a couple of months trying to figure out what we want to do and which way we wanted to go into real estate, we took action and made an investment in a property that was worth at that time around $6 million. So I still remember taking the call and say, you were under contract. And I went, okay, this is getting real now. I need to find $6 million plus a bank to get this thing close and to the finish table. So I think we're pretty decisive on what we want to do. I mean, for us to be able to take this property is just another example. We got a phone call and say, can you step in from the previous buyer and can you do it? And we were able to actually go ahead and do it and underwrite the deal and move forward. We do find a lot of people that do the same thing that we do, and we learn as much as we can. I mean, we didn't know anything about real estate when we started, so we kind of network with all the mentors, fellow real estate investors, and we try to learn every single thing that we can. And we surround with people that can help you and do the same thing. We use a lot of the Lifestyles resources, and our biggest thing is build a strong team. And I think what is in that slide where it says attitude is a little thing that makes a big difference. I think you kind of have to believe in yourself and be able to take these deals. I mean, you might not have all the answers when you get a property under contract for $12 million, but if you have the vision that you can follow, if you can see yourself on the wall with that lion out there, then that's when we start with our investments. So.
And I have seen people at all level in my about 3.5 years now that I've been mentoring. There are some people that think like a lion and they take the initiative and they push along. And I end up having to play devil's advocate and say, have you thought of this? Have you thought of that? And help them build the model. There have been other cases where I have had to push people off the cliff on a 9-unit deal that they were buying by themselves and say, look, if you don't do this deal, I will, because this is a no-lose situation. So it takes all kinds, and we just try and get them all across the finish line, as you said.
Yes. So how Lifestyles has changed our lives. So I left my W-2 job in 2017, kind of after a 20-year career in oil and gas. It was time to let it go. We are both working in real estate, so that's what we do 24/7, pretty much, since we have our own management company and our own employees.
Guess what we're talking about during the dinner, lunch, and breakfast.
Yeah. Sometimes we have to make an effort to not talk about real estate.
You know, we try to say it's not about money, it's about the lifestyle, but there are some of us, this stuff is addicting. And for those of us that have, 3 or 4 properties or 14, unfortunately, I can't live without it at this point. I don't do more deals to get more money. I do it just because I enjoy it, and I can't walk away from a good deal at this point. So
this has allowed us to have some freedom on managing our time. I mean, we're pretty busy, but I'll give you an example. Today we said, oh, we're not going to go anywhere. We're going to do everything from the house. We're still working, but it's just kind of on our own terms. I don't have to show up at 6 o'clock for a morning call in an office somewhere and wait there until the clock hits 5 to leave. So I just do it whenever I want, and which is a lot, but it's something that I enjoy. We have substituted around 80% of our income after the 3 properties. I mean, I had the situation that their calls, we had a really good life, but it was getting on the way to get into a great life. But we took a chance and we said we're going to do it. Yeah, we haven't hit that magic number where we're replacing our total income, but I think we're on our way to get there.
Well, you got income that you were trying to replace too. I know that from previous conversations. So
yes, yeah, it took a leap of faith, but we did it, and we said we're going to get there. We have, I mean, all our friends changed completely. I think all our friends are in real estate. When I get into a meeting with my old friends, I feel like I have nothing to talk to them about it, but that's the way it feels. We self-manage all our deals. We don't have we don't do third party. We started with third party because when we bought the first property, I was full-time in my job, but we made the transition last year in November actually a year ago to self-manage, and we're currently self-managing all our deals.
Short-term goals, we continue building our management company. I think having a strong team is the key of making this is a success. And also we like to get to 500 units. And the long-term goal is to get to 1,000 units plus if we can. And then we like to create recognized management company brands so people actually talk about us and they like to join our team and they know who we are and they know what we can bring to the table. So the recognition is something that will be great for us. Right now we're too small, but we're heading there. And then we also like to deliver long-term growth to our investors because they are the bones of our success. And without them, we wouldn't be where we are right now.
Yeah, that's the main thing. I mean, we want to continue building our company, given the returns to all the people that have supported. We have at least around 100 plus investors in our 3 deals. So it's a big responsibility to make sure we keep delivering and also hitting their goals in their investments. So
this is picture in our corporate office. We actually set up corporate office in the club room on the 2nd floor in one of our apartment complexes.
Yeah.
So we're always there.
So who is in our team? Another funny picture out there. This is what it takes to change a light bulb. It takes an entire team to actually get it done in multifamily. So we had great support initially from Kim. He's been our KP in a lot of our deals. He's the KP in this deal in Fall Creek, and he's been a great mentor to us. We also, I mean, I use all the mentors. When people ask me who's your mentor, and I go, who's not my mentor? Because I normally lean onto everybody. We had several conversations with Curtis also. He has mentored us in a couple of deals. I mean, our investors are the key for it. We would not be able to buy a $12 million asset or even a $6 million asset when we started if we didn't have their support and their trust in it. We rely pretty heavily on our employees. I mean, they're the ones that open the doors and close the doors every day in the office. So we have a duty to them, and that's one of the things that we want to continue growing. We have a lot of lead investors that we network with that I call in for things when rehab operations. It's pretty easy to find somebody in lifestyle that has run into some issue or has done an optimization that you can do. And our job, I see it as finding that person and asking them the question. We also have mortgage brokers and real estate brokers that kind of help us do deals. I mean, it's like this deal with Fall Creek. The broker that brought this deal to us was the broker that sold us our second property, and he said, you guys were really good at closing the second property. Do you want to take this on, and can you take it right now? So you have to build those relationships with mortgage brokers and real estate brokers, and of course are all vendors. I mean, we have a long list of vendors that Gunel manage, but that's key on being able to kind of run a portfolio of around $30 million that we run right now. So. And
okay,
this is
let's go to the questions. I'm scanning them over here. A couple of things. One, somebody's asking about my Ohio properties. I can tell you that my stuff in Ohio is doing really well. Occupancy on all of it, I believe, is at 95+%. They haven't had nearly the fight on delinquencies on rents that I'm experiencing on some of my properties in Houston right now. So Ohio's doing well. There's a couple of questions about the number of employees, and I think we said a couple of things that contradicted each other that we need to answer. So I mentioned that I was going to 1 employee on 130 units. So the general rule is that per 100 units, you can have 1 employee in the office, managing, leasing, et cetera, collecting rents, and another one on the property doing the maintenance work. At 130 units, I had a problem. I can't hire 0.3 of a person so I can have 1.3 people. So I had 2 people in an office. I had 2 people outside doing things. We were able, and these guys talked about as well, if you upgrade all the AC units, then you get rid of the maintenance on all the ACs. Some properties have individual hot water heaters. If you upgrade those, you get rid of all those calls. And then you can slide into a point where you only have one maintenance man. Also, if they're well run and your turnover is not excessive, you get it balanced. You're not having to do big upgrades, installing granite, backsplashes, all these sorts of things. Every time you turn a unit, you just kind of go in and do a vacuum, touch up paint, and move on. You can get that done with one guy on the maintenance side. So you go from potentially 4 on 130 units to just 2 and get all the gains on the payroll. You guys mentioned on one slide that you had 11 people in your structure. The confusion there is that you have a total of what, 3 properties in your portfolio right now?
Yeah, 3 properties.
So that's 11 people spread across 3 properties, and I'm guessing you have about 350 units or something like that?
Yes.
And that includes our regional.
We also have a regional that is included in that count, so.
Okay, so that handles those questions. What's the occupancy currently on Falls?
Right now, we're at 90%, 90 to 91%, so.
Trend at 93.
Okay.
Oh, you're actually reading the question, Scott? Is that what you're doing?
I am. I'm scrolling down the questions.
Oh, okay. Usually the guy here does it, but that's okay. You know,
Hey, we like questions, so we'll be waiting for whoever asks the question.
that's what David does, Scott. Scott, we get to be lazy. Okay, that's what the moderators do here. I have to bring him all the way up to Houston just to do things like this. Otherwise, you know, he feels old, which he is.
Hey, what is the occupancy rate for Fall Creek Square Apartments?
It's 91, we're trending on 93 right now.
Okay. 1.5 years has equity growth of 2 million to 3 million. Will you refinance and pay out the equity then?
Oh, go ahead, sorry.
And then the slide said to supplement in 3 years, 3 and 4. Can you explain that? What does it mean,
Yes.
supplement?
We have what is called a permanent loan in this property. Those permanent loans, they're usually, I mean, this one in particular is 12 years, and there is a pretty hefty penalty if you do a refinance, unless you do it in the kind of the last year or maybe the last 2 years of the loan. So the permanent loans with Fannie and Freddie, they have a feature that is called a supplement, which is basically like getting a second mortgage into it. So you get an additional loan because you have built some equity into your property, and you take that money out as what is called a supplement. You're not doing a true refinance when you're going to get a new loan, because the prepayment penalty is pretty hefty to do it if you do it before the kind of the last 2 years.
So once they do that, they'll have 2 loans on the property, the original loan at roughly $9 million and a second loan at, let's say, $2 to $3 million. And they do plan to distribute the proceeds from that second loan to the partners.
And you can also do a second supplement.
No tax, it's not a sale. So a lot of new people get confused by that. It's another loan on top. Since it's a new loan, it's not a sale, it's not a taxable event. Another question, go ahead.
Was this obtained with hard money and then refinanced, or what?
That's a single family term, just so you understand. This was not a fixer upper. When we show fixer upper apartments, they don't use hard money loans. You know, they don't do that in multifamily. It's a single family term.
Okay.
Where you can put rehab right in the loan on multifamily.
I know.
They're called a bridge loan, just so the new people know.
What is the rent range of the units after rehab, and how did you find the property?
What was the first question, sorry?
What are rent ranges between what and what on your bedroom, like a 1 bedroom or 2 bedroom, and how did you actually find this property?
So rent ranges from rent starts from 1 bedroom for regular units for $950, and the highest rent that we have is 1,600 renovated townhouses that has 4 bedrooms. And I showed my 4 properties around. I haven't seen any property around in that subdivision or anywhere close with 4 bedrooms. It's massive.
It's almost like 1,200 square feet.
It's quite an impressive deal on some of these apartments they have. And so, you know, across the interstate from this complex, and I'm guessing this is where you said you live, there's a neighborhood with a golf course in it where the Shell Houston Open used to be done, and there's $1 million houses right across the interstate from this. So it's definitely a very nice suburban neighborhood that this is in.
That's the same builder, Fall Creek, same builder.
Actually, the guy that built the subdivision built that apartment complex. What was the second question? Sorry.
How did you find the property?
Also, the property, we looked at the property, but I don't think at that time we had the first tag on it, and somebody else had it on their contract that they were going to move forward. So we never progressed it anything past that. So one of the previous broker that I bought the second property from, he gave me a call on December 25th and said, this property fell off contract. Are you ready to move into this property? I know we talked about it, but you were not looking at it. And he said, if you put a deal and you put it under contract by the end of the year and make an offer, it's all yours. So it kind of fell in our lap after chasing it from different sides for a while, and the broker brought it to us.
And just so you know, we have a rule inside of Lifestyles that we don't compete amongst ourselves. So I can tell you that I mentored 2 people on this property before it fell to them, and I don't know if Lee or Curtis mentored anybody else after that. But the seller changed the terms of the deal because the deal didn't work originally as a loan assumption until they dropped that piece of the deal, and it happened to fall into your laps at the right time, and you were able to renegotiate and redo the deal in a different format. So that's great.
Was it because of a time issue where their defeasance ran out, or they just renegotiated different?
Yeah, well, yeah, I think that the problem, if I remember correctly, and it's been 2 or 3 years now, but the problem was, yes, they didn't want to pay the yield maintenance or defeasance on the loan, so they wanted somebody to assume it. But the down payment was so high at the amount that they wanted to sell it for that you just couldn't get any cash on cash return because of all the equity that was required to do the deal. So the seller needed to come down.
This is inside baseball, but this is what my preferred members in a bunch of deals, they want to hear this stuff, and they're going to ask me these questions later, so that's the only reason I'm asking it.
Yep.
Another thing, that owner was an outstate owner, and they had only one property in that area in Texas, in Georgia. They just were ready to get out of that investment.
Yeah, they were looking for somebody that wanted to close, and we were kind of in the right place. So we negotiated the price, and we said we can do it for that, and it makes sense for us with the numbers. We said, yeah, we can close in 60 days or sooner if we can. So
that's similar to my Lennox property, my second property that I bought. When I first looked at it, I think it was $10 million or something like that. And it was the crown jewel of this company's portfolio in this area. Well, they sold everything else, and then their expenses to support this one property were so high that they dropped, and I got it for 7.8 million. Eventually.
Yeah, they lost the economies of scale, and that's the reason.
Yeah, so stuff happens.
When we took it over, it had a lot of payroll built into the deal. So.
Yeah, because when it was originally a Class A few years ago, they had bigger, more healthy payroll probably, and you could downsize that. So.
Correct.
Yeah.
How many deals had you purchased when you left your W-2 job? How many have you added after leaving that job?
So I left my W-2 job after the second deal. So I did it when we were like 60% of our kind of income. And then that's the time that we kind of left. I was doing a little bit of kind of consulting to supplement that, but right after we bought our third property, it was like, I think we're in a comfortable position, and we're going to dedicate ourselves into actually managing the properties full time.
Do you still have number 4 under contract here in West Chase?
Yes.
Okay.
How do you develop good employees?
I'll let Gunel answer that.
How do you build good employees?
Yes.
Training. What you need to do is that you probably need to go there at the same time when they arrive to the office, not to bug them to death, but to find out what they're going through. See what they spending their time on, what is dragging them down, and try to optimize their time. But you do need to be in the office to be able to see that, not just fly by for 1 hour and give them directions, do this, do that. You kind of need to feel yourself in their shoes to find what you can optimize from them, take out from them, so they are more efficient with what they do, and provide them training.
Yeah, we do a lot of training. We use a lot of technology, and just kind of live day by day with them to see what are the things that are stopping them to actually being able to achieve what they need. So.
And another part of our team, we have the mentor, Scott Van Nostrand, but another thing once you join Lifestyles is we have operations consultants, ladies in the industry, 20 and 30 years, that they can reach out to about employee training of what size for this property. So there's a lot more to it once you get involved.
Yeah, I'm glad you brought that up. My job is to get you to the finish line at the closing table, and then Randa and the other operations consultants, it's their job to step in and answer your questions about how to actually operate the thing.
And you need to keep evaluating your employees. I mean, it is there's pretty high turnover in the multifamily business, so you kind of need to keep checking what they are, make sure they're motivated, and sometimes you have to change, then you have to make that decision too. So
we had employees that were with us for 3 years and still with us for already 3 years, and we have employees that lasted 1 week.
Yep. Yeah, and fire quickly is very important in this industry because it affects you and your partners. Absolutely. But with love. Fire with love.
with a smile.
How long after the broker called you did it take you to put the deal together and for people to invest?
So we got that call on December 25th. We closed in March 30th of the next year. So somewhere around a month to negotiate the contract and then 60 days to basically close. Yeah.
Yeah, typical deals take 60 to 75 days close, so that is normal time range, just so new people know.
How much did you guys put into this deal?
We invested 100,000 into this deal.
Okay.
150 maybe. I have to look at the Schedule A.
Do you want to add something or no?
Well, I was going to say, if that question was coming from somebody who thought they might want to be a lead, we actually have a procedure and a process for raising money. We have a new online portal called Podium that helps in the process. I was just having a meeting earlier today with the banker that I mentioned, and I was supporting another member who is under contract and going for their loan. And he asked how long it was going to take her to raise the 3.8 million, I think, that she was trying to raise. And I said less than a week, because she's done all the things to get in position. She's about to let her investment memorandum go out to the group, and it'll fill up pretty quick.
Yeah, I think we
ready to go.
In like the first probably 2-3 weeks when we put this in it. So
yeah, in Lifestyles, it's very organized. Once they get in a contract, they do a feasibility period where Scott will go out to the property with leads like this, and they'll walk the property. They'll teach you how to do all that every step of the way, what to look for, and they'll explain all that to you. So. You have another question?
Kind of looking through.
One more.
So did you say you have no full-time maintenance person? And if so,
No.
how do you get around that?
We do have full-time lead maintenance, but we don't have 2 maintenance teams on the payroll. It's just lead maintenance with some support from maintenance technician on make readies. And we have a rotating person that would go to each property twice a week and help as needed. So if, let's say, we have a product ready, we are not behind in work orders, he doesn't even need to go there that week.
Yeah.
and we have a full-time person managing.
On the payroll earlier, on 100 units, you have 1 full-time inside, 1 full-time outside, and then you could supplement if you have to, if you get above that. So just so people understand the economies of scale.
What events cause a 1-week employee?
They're saying, why do you only last a week? They want to hear a horror story, I guess.
not following our procedures. Yeah. So
Okay.
if they're not following our procedures, I mean, we spent some time with them at the beginning, and they try to kind of reinvent the wheel when we let them loose. It's like, sorry, you got to go. You're not getting in line.
You got to do it my way. I don't care what you did your last property. That's not me. I get that.
We spend quite a lot of time on onboarding people and training people, and then at the end of that, they not following any instructions and they just do things their own way, then that's not going to go anywhere.
Right.
Yeah, take partial payments when we're done. That was the last one.
Well, thank you so much, guys, for giving back and sharing your story, and thank you, Scott. Great, awesome mentor that you are. You know, I'm going to stay on board here with David and answer any other questions about membership or anything, and we're going to cover the membership with y'all. But thank you so much, guys, for coming tonight. Okay.
Appreciate it.
Thanks for the opportunity.
Thank you.